Good evening, everyone. Today's closing numbers on Wall Street don't really tell the story at all. Yes, it was a down day, but at the opening bell, it looked like it could have been one for the record book. Stocks dived from the get-go. Within minutes, the Dow was down nearly 200 points. There were fresh worries about slowing growth in China, to be sure, but that wasn't the half of it. What really spooked investors was this: the stunning sight of tens of thousands of pro-democracy demonstrators flooding the streets of Hong Kong. Police cracked down hard. Banks and other Hong Kong businesses shut down for the day. Stocks sold off in Asia, then in Europe. The demonstrations continued well into the early morning hours Tuesday and may well continue for another day. After that early tumble, though, U.S. stocks fought back. Here's how things looked at the closing bell. The Dow down just 42 points. The Nasdaq lower by 6, and the S&P 500 lost 5. In Hong Kong, the Hang Seng Index had a terrible Monday, with stocks falling nearly 2%. Susan Lee is on the ground in Hong Kong with more on what the protesters are demanding and why investors are paying such close attention.
The streets of Hong Kong are flooded once again with protesters, more than the 80,000 that were estimated to have taken the streets over the weekend, and they have virtually shut down the fifth largest international market in the world. Now, what made the international community really take notice was the escalation in the confrontation from the Hong Kong riot police and also from the Hong Kong government, firing in tear gas and pepper spray at the crowds yesterday, which we haven't seen since the handover from the UK back to China in 1997. At one point, the Hong Kong riot police holding up signs saying "disperse or we will fire." And the speculation amongst the crowd was they were readying rubber bullets to be shot, though we don't have individual confirmation of that. And it really harks back to 1989. The reason for this is that this is meant to be a peaceful student movement for democracy in Hong Kong. And people can't help but make the comparison of the tanks rolling into Beijing in 1989. It looks like the movement has been rewarded with a softening stance from the Hong Kong government. The second in command, the chief secretary tonight, has told the people of Hong Kong that they will take a second look at the hard stance from Beijing and hopefully take a look at the right for Hong Kongers to vote for their leader in the future. But she did say that given the chaos that we are seeing in the city, that might take some time. For Nightly Business Report, I'm Susan Lee in Hong Kong.
Let's turn now to two market experts for more analysis on all of this. We're joined by Michael Farr, president of Farr, Miller & Washington, and John Rutledge, chief investment strategist at Safanad. Gentlemen, welcome. And John, let me begin with you. You know, looking at that video, it's pretty unsettling to see those mobs of protesters. But here we are, thousands of miles away from all of that. To what extent that what's going on in Hong Kong and those protests impact the U.S. economy and the U.S. markets? How important is it?
Well, I think it's quite important because it's going to be building over time. It's not an instant blow-up problem, but our market is pretty ready for a correction anyway. As we've seen, it's been going up a long time. It's got some pretty silly-looking IPOs recently, the Alibaba IPO among them. And I think it's about time for it to take a breather. But the economy's in pretty good shape. The economy's not going to be knocked out of the box by the Hong Kong situation unless it interrupts shipping.
Michael, do you see it the way John does?
Well, not exactly. I see these protests as something that happen from time to time and have gone on for a number of years, protesting for democracy. I think that the police and military in China have learned their lesson against becoming too heavy-handed and creating a larger incident that would result in sanctions and other things. I mean, they know with enough experience not to overreact. So I think this passes as long as it doesn't escalate. I think the China investment story is largely intact, though I probably wouldn't put money in today.
What about John's argument that we're due for a correction and that that some of the froth, as evidenced by the Alibaba IPO, is further argument lending credence to that thought?
Well, I think a completely different subject, but we've been expecting a correction in U.S. markets now, I think, for 3 years. Certainly, this is probably the most over-anticipated correction that just hasn't happened in my career. So, yeah, we're due. He's right, but it just doesn't seem to happen. This could be the spark, or we continue back as normal. It feels toppy.
Mm-hmm. You know, let me ask you this, John. We know that the Chinese economy has been weakening for quite a while now. How vulnerable is the Chinese economy to this conflict in Hong Kong? And then you know, by virtue of that, what ripple effect could that have on all the American companies that do business there?
Chinese economy is complicated like layers of an onion. And one story in China is growth is slower than it was. That's true. It's also different than it was. Less infrastructure, less heavy metal, less manufacturing, more services, more finance, and so forth. That restructuring will continue, and also says growth will be more like 7 than the 10s we got used to. But let's face it, this economy is $9 or $10 trillion in size. If it grows 7%, that's a $700 billion increase in GDP for the year. They're still doing okay. In the short term, the Hong Kong thing could spook people a little bit, in which case you could have a hiccup for a quarter or so. But I think the China growth story is intact. As I think Michael was saying, that doesn't mean I want to buy Chinese stocks listed in China. I'd rather make my China bets in the U.S. and other places where I trust the courts, the judges, the audits, and so forth more.
Michael, I can tell you want to jump in there. Go ahead, but also spin the reel forward a little bit. We're going to begin the final quarter of the year here, day after tomorrow. What do you expect?
Okay, first, I was going to jump in with just one risk that I see out there, and that's our complacency. We seem to believe in that central planning that China's been doing will work. We've avoided, or they haven't seen a real downturn in the business cycle in China since 1994. Somehow we, I think, are drinking the Kool-Aid that it won't happen. If this negative downturn continues and less than 7% or less than 6% and so forth growth occurs, that causes pressure on commodity prices. That affects all of us. As we come into the end of the year, Ty, more than ever, I feel like it's a jump ball. To me, we could certainly be at the beginning of a significant correction. We are overdue, but we've been waiting a long time. The Fed is still nearby, and anybody who's bet against this trend has lost. So cautious and careful, and know what you own, and make sure they're good balance sheets and real earnings with companies.
All right, gentlemen. Thank you so much. Thank you, Michael. Thank you, John. Michael Farr,
Thank you.
Miller in Washington, and John Rutledge at Safanad.